Hello everyone. Welcome to the Stock Minds web channel. Palomar Holdings, NASDAQ, PLMR, a leading specialty insurance provider, has recently delivered a strong Q1 2025 earnings report that underscores both impressive growth and robust value. With revenue surging 47%, free cash flow per share more than doubling, and analysts maintaining bullish outlooks, this quarter's performance marked a compelling narrative for long-term investors. In this video, we will dive into Palomar recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Palomar Holdings. Palomar Holdings, founded in 2014 and headquartered in La Jolla, California, is a specialty property and casualty insurance company. It focuses on underwriting catastrophe-exposed risks such as earthquake, hurricane, flood, and inland marine across residential and commercial markets. Palomar operates in both admitted and excess and surplus lines, distributing its products through retail agents, brokers, and program administrators. The company leverages proprietary technology and advanced risk analytics to drive underwriting precision and efficiency. Palomar financial performance. In the first quarter of 2025, Palomar Holdings delivered outstanding financial results that highlight its accelerating growth trajectory. The company reported revenue of $174.63 million, marking a 47.33% increase from $118.54 million in Q1 2024. Earnings per share, EPS, also saw significant improvement, rising 62.69% year-over-year to $42.92 compared to $26.38 in the same quarter of the previous year. On a trailing 12-month TTM basis, revenue reached $609.96 million, up 50.51% from $405.26 million in Q1 2024, while TTM EPS climbed 43.71% to $5.02, compared to $3.49. A particularly notable highlight is the company's free cash flow per share, which more than doubled, surging 126.73% year-over-year to $11.79 from $5.20. Profitability metrics remain strong, with a gross profit margin of 30.93%, net profit margin of 21.99%, and an exceptional free cash flow margin of 51.63%. Efficiency ratios further underscore the company's solid fundamentals, with return on assets at 4.96% and return on equity at an impressive 20.76%. With no significant debt on its balance sheet, Palomar maintains a conservative financial structure. Over the past 5 years, Palomar's revenue has been growing at a 36.2% CAGR, net income at 105.7%, and free cash flow at 49.3%. Palomar is one of the fastest-growing insurance companies, and with the Q1 2025 financial results still showing rapid growth, this momentum could continue. Palomar Fiscal 2025 Financial Forecast. Looking ahead, analysts forecast 2025 revenue of $733.86 million, representing a 42.92% increase over 2024's $553.86 million, and expect non-GAAP EPS to rise to $7.10, a 39.58% improvement from $5.09. Analysts assign a buy rating with an average price target of $183, a potential upside of 12.75%, and a high target of $205, offering as much as 26.31% upside potential. PLMR stock price performance and valuation. At the time this video was created, the stock was trading at $162.30 per share. Palomar Holdings' stock has shown exceptional performance in the equity market, increased 100.6% over the past year, significantly outperforming the S&P 500's 10.1% gain during the same period. Since its IPO in April 2019, the stock has appreciated by a remarkable 712.3%, again outpacing the S&P 500's 104.9% return in that timeframe. Despite the substantial price appreciation, the stock remains attractively valued based on key financial ratios. Palomar currently trades at a price-to-sales PS ratio TTM of 6.85, with a forward PS of 5.86. The company's non-GAAP price-to-earnings PE ratio is 32.07, with a forward PE of 25.77, indicating investors are paying a reasonable premium for Palomar's consistent earnings growth. Moreover, the price-to-free cash flow (PFCF) ratio stands at a compelling 13.83, reflecting undervaluation compared to its growth. Based on FinChat data, if we look at the valuation over the past 5 years, the forward PS is slightly below the average, while the forward PE and PFCF are significantly below the average, especially the PFCF. This indicates a potential undervaluation, as Palomar is still projected to grow rapidly. Palomar growth potential. Palomar growth prospect remains strong, driven by several factors. 1. Revenue and premium growth. Palomar's Q1 2025 results showcase robust top-line expansion that provides a solid foundation for future growth. Gross written premiums increased 20.1% year-over-year to $442.2 million, compared to $368.1 million in Q1 2024. More impressively, the company achieved 37% same-store growth when excluding discontinued lines of business, demonstrating strong underlying momentum across its specialty product portfolio. Net earned premiums increased 52.1% compared to the prior year's first quarter, reflecting the company's growing market presence and successful product expansion. This substantial growth in earned premiums indicates that Palomar is not only writing more business but also retaining and earning on that business effectively. 2. Market position and competitive advantages. Palomar has established itself as a leading specialty insurer with access to both admitted and surplus lines paper. The company's multi-channel distribution network serves residential and commercial clients, with products that resonate with producers, other insurers, and reinsurers. The experienced management team brings industry expertise and long-standing collaboration, positioning the company to capitalize on market dislocations and growth opportunities. The company's excellent financial strength rating from AM Best provides credibility and competitive positioning in the marketplace. 3. Raised 2025 guidance. Based on strong Q1 performance and successful reinsurance renewals, Palomar raised its full-year 2025 adjusted net income guidance twice during the quarter. The company initially increased guidance from between $180 to $192 million to between $186 to $200 million following Q1 results, and subsequently raised it again to between $195 to $205 million after completing successful June 1st reinsurance programs. This upward revision reflects management's confidence in the company's ability to sustain growth momentum throughout 2025. The guidance includes an estimate of between $8 to $12 million of catastrophe losses for the remainder of the year, demonstrating conservative risk management. Risks to consider. While Palomar growth is strong, we should be mindful of potential risk. 1. Profitability and risk in new growth areas. Palomar's expansion into new lines such as fronting, professional liability, and casualty insurance carries significant risks. These areas are more complex and volatile compared to its traditional earthquake insurance business. Challenges include accurately pricing risks and managing reserves, with the potential for unexpected claims and reserve charges similar to those seen by industry peers. Failure to achieve expected returns in these segments could lead to investor confidence loss and stock price decline. 2. Catastrophe exposure. Palomar remains vulnerable to large-scale catastrophic events, particularly earthquakes. Although the company has a robust reinsurance program designed to mitigate these risks, significant tail risk remains. The company uses a conservative risk management approach, including catastrophe excess of loss and quota share reinsurance contracts, and maintains diversified reinsurance partners. However, Large natural disasters could still impact financial results. 3. Competitive pressure in professional liability. The professional liability insurance market is becoming increasingly competitive, which could lead to pricing pressure and reduced profit margins. As more insurers enter this space, Palomar's ability to maintain growth in this segment may be challenged, especially given its focus on underserved markets with limited competition. Conclusion: Palomar Holdings stands out as a high-performing specialty insurance company with a compelling combination of strong financial performance, attractive valuation, and long-term growth potential. With a well-diversified business model, disciplined underwriting, and expanding presence in high-demand insurance segments, Palomar is well-positioned to sustain its momentum. While investors should be mindful of risks such as catastrophe exposure and market competition, the company's strong fundamentals, risk management, and strategic execution make PLMR a stock worth considering for growth-oriented portfolios. But remember, this is not a financial advice. What do you think about Palomar Holdings? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.